Hi, I'm Richard Brown, Chairman and Chief Executive Officer of JMBA Financial Advisors. Planned giving is a great way to give back to nonprofit organizations. There are several ways to make a planned gift, many of which provide benefits for you as a donor. First, gifting to a cause close to your heart is a wonderful way to make an impact throughout your lifetime. And secondly, your generosity and planned gift can also be a smart, tax-efficient decision. Today, I'm going to talk about two gifting strategies: donor advised funds and appreciated stock. Let's start with donor advised funds. A donor advised fund is a charitable account in which investments can be used for the sole purpose of distributing gifts or grants to various charitable 501c3 organizations. With a donor advised fund, you can make grants or gifts directly to qualified charitable organizations that are significant or meaningful to you. It's important to note that funds placed in a donor advised fund are irrevocably gifted and cannot be returned to you at any point. So how are donor advised funds tax efficient? When you contribute stock, cash, or other investments into a donor advised fund, you receive a tax deduction for the amount gifted in the year the gift was made. There are some limitations on the total gift amount you can deduct on your tax return. We recommend talking with a financial or tax professional to discuss if these limitations could apply to you. If you are someone who routinely gifts, you could explore a bunching strategy with your tax professional. Bunching is when you make a large contribution to your donor advised fund in 1 year. In the year that you make a large contribution, you can itemize your deductions on your tax return. In subsequent years, you can claim the standard deduction while making charitable gifts from the donor advised fund. Another planned giving strategy is appreciated stock gifts. This is when you make tax-efficient gifts to charities by transferring securities with large unrealized capital gains to your charity of choice. So how is this tax efficient? When you gift securities with unrealized capital gains, you avoid paying capital gains tax. Traditionally, someone may sell the securities, pay the capital gains tax, and donate the cash. But by donating the appreciated stock, you avoid the additional steps and the additional taxes. It's important to note that not all nonprofit organizations can accept securities, so be sure to confirm that this is an option with your charities of choice. And once again, it's important to consult with your tax or financial professional to determine the tax implications of a large gift. For all donations, make sure you receive a receipt from the organization receiving your donation. It's important to show the date of your gift and the detailed description of what you donated. If you have any questions or to learn more, feel free to reach out to your JMBA advisory team. Thanks for tuning in.